Imagine walking onto a car lot and realizing that every single vehicle you see is likely owned not by the dealer, but by a bank. In fact, over 80% of vehicles at auto dealerships are financed through something called a floor plan loan. Most people have no idea this even exists. So, what is a floor plan loan and why does it power nearly every major dealership out there? Have you ever wondered how dealers afford to keep millions of dollars worth of inventory on their lots without going broke? How can a small business have dozens, sometimes hundreds of high-value items on display? Here's the secret: floor plan loans. Think of it as a gigantic credit card, but exclusively for inventory. So how does this work? A lender, usually a bank or specialized finance company, gives the dealer a revolving line of credit. The dealer uses this line to buy inventory: cars, RVs, motorcycles, or even boats. The dealer doesn't pay for these vehicles up front. They finance them using the floor plan loan, which is secured by the vehicles themselves. Here's a question: what happens when a car sells? The answer is simple. The dealer repays the portion of the loan tied to that specific car. It's like selling a TV bought on credit and then immediately paying off that purchase. The beauty is, as the dealer sells inventory, that credit replenishes, allowing them to restock with new models without ever tying up huge amounts of cash. Why is this better than just using a traditional business loan? For one, it's flexible. The revolving nature means dealers can respond quickly to changing demand, stocking up for busy months or scaling back when things slow down. Plus, they only pay interest on the money actually in use, not the entire credit line. Could there be risks? Sure, if inventory sits unsold for too long, interest costs stack up. But for most dealers, the ability to showcase more products drives more sales, outweighing the downside. And with programs like the SBA's Dealer Floor Plan Pilot, even smaller dealerships can access these loans, with amounts ranging from $500,000, 0 cents, up to $2 million, 0 cents, and government-backed guarantees reducing lender risk. Another question: who qualifies for floor plan loans? It's not just car dealers. Businesses selling RVs, motorcycles, manufactured homes, and boats can tap into this financing. The only catch? The inventory must be titled, meaning it has official ownership papers, making it easy for the lender to claim the asset if needed. Well, what's a real-world example anyone can picture? Imagine a family-owned car dealership. Instead of saving for years to buy 50 cars outright, they use a floor plan loan to stock their lot, pay interest as each car rests on the lot, and repay the loan with every sale. This model keeps their cash flowing and their business growing. Looking for unconventional solutions? Some dealers use floor plan loans in creative ways, like leveraging seasonal demand spikes, stocking up before summer with boats and RVs, then quickly turning over inventory to minimize interest payments. Others negotiate with lenders for flexible repayment terms or reduced fees based on performance. So, what's the ultimate benefit? Floor plan loans let businesses punch way above their weight, offering more selection and flexibility and freeing up cash for marketing, upgrades, or expansion. It's a game changer for inventory-based businesses. Because understanding how to leverage the right loan can transform a business, the next video reveals how hybrid loans combine the best parts of multiple financing options, giving you even more power, flexibility, and control over your business growth. You can't afford to miss what's next.